Hey guys, I'm gonna do a kind of a different video for you guys. This will be really short and to the point, I think. I wanted to do a video about how I prefer to invest. Um, so I'm not going to give you my standard disclaimer, but I will say I'm not a financial advisor. This is just entertainment. Any investment you do can be risky. But having said that, this is my ideal way to invest. Um, so what you see here is the asset class, the subclass. I don't know why I have so many S's in class. Let me fix that. My target allocation, my expected rate of return, cash on cash rate of return, the pros and the cons. So what we have here, broad categories are real estate, equities, well, short-term bonds are actually debt, but let's just call it equities, trading, and crypto. So this is how I'd like to invest, ideally. It's sometimes difficult to get to this allocation, and one of the reasons is that, for example, you'll see here I have real estate at 50%, Forex at 25%, and holding crypto at 10%. If you work a 9 to 5 job in the US or a regular salaried job in the US, probably you have a retirement account, and probably that is a large part of your savings. And within that retirement account, you probably can't do any of those things. You probably can only invest in what you see on these lines right here inside your retirement account. So what this means is a lot of us, me included, have a large allocation in the stock market when really we might prefer to be or be better off allocated in another way. And so the only way really to shift that is to save less in your retirement account and use money outside of it, which is not necessarily a wise move because your retirement account comes with some tax savings. Although it can be a good move if you really know what you're doing and you have a good plan. Still, though, I think it's a good idea to save some in your retirement account for sure. And ideally, you're maxing that retirement account and saving more on top of it for these other things. If you can put yourself in that kind of position, then you're doing really well. So let's go through these asset classes. First, real estate. Specifically single-family home rentals. That can also mean a duplex, a triplex, a quadplex. It could be a multi-tenant building, but it does not mean commercial real estate or apartment buildings. Those are a different type of investment, in my opinion, and they're not as good as an investment, in my opinion. Those are good if you have a lot of money to deploy. So if you say, I have $1 million I need to deploy into real estate, or let's say more, 2 or 3 million I need to deploy into real estate, then maybe multifamily makes sense for you because you can deploy that money there. But if you are looking for efficiency and you're a smaller investor, then in my opinion, and I've been in real estate a long time, single family rentals are your best bet. They're very efficient. You get a better cash on cash return. You have more control, and they do better when there are economic problems. This is my opinion and my experience, how I see it. I'd like to be half allocated in real estate. I expect to make about 25% a year on my money when I'm in real estate. The ways I make that money are that, well, first of all, this isn't a way you make the money, but real estate is a fantastic inflation hedge. That's one of its best properties. It should be tax-free if you have a good accountant and you do it properly because you can use straight-line depreciation. You can write off all your expenses. If you decide to sell the property and roll it into another property, you can use a 1031 exchange to avoid paying taxes or to delay paying taxes essentially forever. It's a really should be tax-free income for you overall. It's multidimensional. In other words, you get appreciation, so the value of your property will almost certainly go up over time. Historically in the US, we get about 5% annual appreciation of property. It doesn't mean every year it's going to go up. It could go down. It could go up. But as long as you're not selling it and you're just renting it, you can afford to wait for the value to be up before you sell. You should get rental increases over time with that property. It doesn't mean you'll get them every year. It doesn't mean you'll never have to lower your rent. But over time, on average, your rent should be going up. A lot of cities in the US, you could probably 20 years ago rent a place for $600 and feel like you were paying about an average price. Now, I doubt there are many cities in the US, at least big cities, where you can rent for that. 20 or 30 years ago you could. Now you're probably renting for $1,500 a month. Rents over time go up, period. And the main reason is that they're driven by inflation. So that's one of the reasons it's an inflation hedge. Another advantage is that the tenant is buying it for you. So typically when you screen a tenant, you're looking for their income, their monthly income, to be 30% or to only have about 30% allocated to the rent. That's ideal, and maybe a third allocated to paying their rent. What that means is essentially someone is out there working for you and spending about 30% of their income to pay for your property. That means they're paying your mortgage, they're giving you some extra spending money every month, and they're buying it for you while they live in it. That's fantastic. The more people that'll give me 30% of their income every month and pay my properties off for me, the happier I am. You also get bank leverage. So you should get maybe a loan at around, depending on, it could be higher, it could be lower, but generally 5, 6, 7% loan. You're getting that usually at a fixed 30-year loan, and I prefer that over a 20-year loan. There are reasons for that I won't go into in this video, but you're getting, really, that is an asset, that mortgage, in my opinion, because it's a fixed long-term debt that you can use to leverage and buy more than your money really can buy. So if I invest, let's say $50,000, and I put that down on a rental property, I'm probably going to buy a rental property that might be $200,000 or even $250,000 rental property. So I've leveraged that $50,000. I now control, if I do that 4 times, I might control close to $1 million in real estate, but I've only invested about $200,000 of my own money. The bank's invested the rest. And they're letting me use that money at a 5% rate, and I'm getting more than that back in returns. So you also have locked-in payments. So for example, if you buy a place, let's say your PITI, your mortgage, your interest, your taxes, your insurance, all that is, let's say, $1,000 a month. That's probably, unless you refinance it, never going up, or maybe going up very slightly when property taxes are reassessed. So essentially you're getting locked in payments. And if you buy a place, let's say you buy a place and your monthly payment is, let's say you put down $50,000, your monthly payment, PITI, is $1,000, and your rent is, let's say, $1,400. You pay your property manager $100 a month, you're left with $300 cash flow, which is the next item here. And then that payment of $1,000 a month seems like, okay, I can manage this. But in 10 years, the chances are your rent has gone up, your payment has not gone up. So now maybe in 10 years your rent is $1,500 or $1,600, and your payment's still $1,000 a month. So over time, you start to have a higher and higher margin on your income or your rent compared to your mortgage. So in the long term, it's great. Okay, let me move on. The cons, it's capital intensive. Really, to me, you shouldn't be buying those C-class properties, those, you don't want to buy sort of in a high crime area where your tenants don't care about their credit. They're going to move out without telling you. They're going to leave the place trashed. They're going to stop paying rent. You might have to evict them. Can you make money on those? Absolutely, you can make money on those. But you really need to be savvy. You need to manage them closely, and you need to keep a big reserve. To me, it's much easier as kind of a newbie investor. I'm not a newbie investor, but if you're a newbie real estate investor, buy a newer property, put 25% down. What this means is you're probably going to need to save up $50,000 or $60,000 to buy the property. So that means it's capital intensive. You need to keep a reserve for maintenance and vacancy. So what happens if you can't rent the place for a few months? Can you still make your payments? What happens if you have to make a repair? Do you have money saved for that? So I like to keep about $10,000 reserved per property. I think that's a good number. Also, you should consider a property manager for sure. If the rental is right next to you, go ahead and manage it yourself. Or if you think you really can do it and you're savvy, it's maybe a good strategy to manage it. But it's much easier to hire a property manager. But you have to manage that property manager. You have to make sure that they're doing their job. You have to communicate with them. You don't want to talk to them too much because then they won't want to talk to you, but you need to manage that property manager. And real estate investing is better if you are savvy. In other words, what markets should you be investing in? What neighborhoods should you be investing in? What types of property should you be investing in? What types of leases should you be signing? Short leases, long leases. You want to make sure your tenants are renting in the good months, or signing a new lease in the good months, which is May, June, July. How do you arrange that? There's lots and lots of things to consider when you're investing in real estate. That's just the tip of the iceberg. But overall, I would want to be 50% in real estate. Okay, so enough about real estate. I could do. Okay, enough about real estate. I could do a set of videos, or a lot more than that, about real estate, because there's just so much to know here. But it's a little bit foolproof if you just buy newer properties in good shape in markets in the south part of the U.S. that are reasonably priced, not high priced. You can't go too far wrong there, I think, and it's a great place to invest, where I would like to invest about half of my money. Next line 5 here, is equities. So basically we're talking here about stocks, ETFs, mutual funds, short-term bonds. The way I'd like to be allocated is 10% of my money into stocks, 4% into ETFs, 1% into short-term bonds. These are my expected rates of return. It really depends on, what you look at. For example, over the last 50 years, stocks have returned on average something like 11%. But over the last maybe 10 years, they've returned much more. Or not, I don't know, much more, but more. So it really depends on, the market cycle and what's happening with the market. It could be more, it could be less, depends on what period you look at. But let's just say 15% a year for stocks, and probably that's a little generous, to be honest. Maybe 14% a year with ETFs. The reason I have ETFs a little lower is they come with some fees. And generally you're buying, when you buy ETFs, a bunch of companies that maybe aren't so great. Whereas if you're buying individual stocks, if you're savvy, you should be buying, hopefully, mostly companies that are strong companies, or if you're doing more speculative investing, at least companies that have a good risk to reward ratio. In other words, a lot of reward for the risk you're taking by speculating in those stocks. And then there's also a strategy of buying dividend producing companies, which is a very complex topic, not one for this video. It can be useful, but your returns might not be as good in the long run as they would be with a more diverse or broad strategy. There are arguments to be made on both sides of that. I know you may agree or disagree with that. That's just my general statement to make this brief. So with stocks, you have a chance to invest in good companies. You have a chance to diversify across economic sectors. So you can invest in energy. You can invest in transportation, you can invest in consumer goods, you can invest in tech, you can invest, just so many ways you can invest, and you can really spread your investments out. You can spread them out globally. You can buy, Pacific Rim stocks, and you can buy small cap, or mid cap, large cap African stocks. You can buy Swiss stocks. There's just so much you can buy, or funds, I shouldn't say stocks. I don't know if you can buy Swiss funds stocks on the U.S. stock market. Generally, you can't unless they're listed here. But anyway, the point is you can invest globally this way. And with ETFs, it's more of a, investing for dummies. If you don't know much about investing, don't try to pick stocks. Just invest in ETFs. What are the downsides here? Well, with stocks, the returns they're good, but I would say lower than some of these other categories. With ETFs, you have a little higher fees, and your returns are maybe slightly lower on average than buying stocks, assuming you do a decent job of picking your stocks. I'm not talking about day trading here. I'm talking about buying and holding. Day trading is hard work. You really need to be an expert if you want to do that. Buying and holding is probably the strategy for most of us. Next line here is short-term bonds. I expect about a 4% return from short-term bonds. Maybe higher. Maybe, let me just change that. I'll just change that to 5. Maybe higher. For example, there's a mutual fund that is a bond fund, a short-term corporate bond fund that I like. They're called FAGIX, F-A-G-I-X. I would expect the returns from that to be higher, but also the volatility to be a little higher. One of the pros of bonds is it serves as ballast for your stock investing. So if the market turns down, you should then rely on your stocks to potentially buy the dip, your bonds to potentially buy the dip in the market. And you shouldn't lose money on the bonds, or not as much, I would say. Also, if you need to make withdrawals from your retirement accounts or your stock investment accounts, probably the place to take those withdrawals reliably is from bond funds. Whereas if you try to take it from stocks, you might have to sell stocks when they're down. When you don't really want to sell that stock, you prefer to hold it, and then you're forced to sell it. So having bonds gives you some ballast and some flexibility in your investment. What's the downside of bonds? Well, poor returns. Um, bonds used to actually do better 30 years ago, but they don't, and 40 years ago, but they don't do as well now as they did back then, 50 years ago even. The returns just aren't quite as good on bonds anymore. Okay, so next line here is the one that I kind of specialize in, which is trading. You can trade Forex, gold, silver indices, and there are also other things you can trade. I didn't list on here futures and commodities, and you could trade soybean futures, whatever you want to trade. But the main things here you can trade are Forex, gold, silver, and indices, and crypto. So I don't think trading crypto is the right place. I wouldn't choose it. What are the pros of that? It's volatile, big gains, but you can also have big losses. The biggest con to me is that it has huge trading costs. Your spreads and your broker fees are very high when you're trading crypto. So you're going to need to take big moves with crypto successfully to make money. Now, you can make money with crypto, trading crypto. Absolutely. I'm not saying you can't. You certainly can. You can make a lot of money trading crypto. But you better be good at it. You better know what you're doing, and you better go for those big moves. If you can do all those things successfully, then you can make a lot of money with crypto because crypto's growing. But to me, and I'm going to skip line 9, I'll come back to it, the trading line for Forex. To me, I would rather allocate my crypto investment money into holding. So I buy and hold cryptocurrencies. And generally, I don't invest a lot into the small market cap or the altcoins. I invest some there, but I invest probably 85% of my crypto investment is into the large caps. In other words, the top 10 cap cryptocurrencies. So we're talking the Ethereum, the Bitcoin, the Cardano, the Polkadot, the BNB coin, the Binance coin, etc. So those to me are probably the places to invest in crypto and hold. And then I sprinkle in some of the smaller altcoins like VeChain and BAT, which is for the Brave browser, the BAT token, and IOTA, maybe some others. But to me, those are just very speculative and really not where you want to put much of your crypto money. You should put some there, though, because if those blow up, those have a high reward potential. But to me, I would rather stick with some of the larger cap cryptocurrencies and hold them. So to me, I would like about 10% of my money in the crypto market, but I don't want to trade it. I just want to buy it and hold it. It doesn't mean I never sell cryptocurrencies. I do. I sold some Bitcoin recently because I felt like it was going to go down because of all the negative press about the energy usage of Bitcoin. It might go back up, but I sold some of it. I didn't sell all of it. I just sold some of it and invested that money in a few other cryptocurrencies, although all cryptocurrencies are kind of taking the ride down with Bitcoin, and that's kind of how it works. I held some in cash and just bought a little bit of some altcoins this morning. So yeah, it's not that I never trade it, but it's very slow and very rare that I trade it. I mostly just hold it. Then the line that I really didn't talk about, which is trading Forex, gold, silver, and indices. This is where I want about a quarter of my money. You can get big returns here. The cons are that it's risky. You have to pay taxes on it. And of course, you have to pay taxes on your crypto gains. You have to pay taxes on your stock market gains unless it's in a retirement account. But you have to take into account that you're going to need to pay taxes on these gains. It is a difficult market. Most people lose money here. And it takes skill. So unless you know what you're doing or you can find somebody to trade for you that knows what they're doing, this is a dangerous place to trade. But for me, I would like about a quarter of my money here. I can make incredible returns here, just as I can in crypto. I would expect to roughly double my money every year in crypto and in Forex. So looking at this, you might think, well, why not just put everything in a Forex or in crypto? And the reason is two things: risk and diversification. So I like to diversify. That is one of my guiding principles. I will never put all of my money into one thing, ever. I always want to be spread out. And then, as I've said before, and I say at the beginning of every video I do for you guys, Forex is risky. So is crypto. It's risky. Many cryptocurrencies could go to zero. It's very possible. They could be outlawed. They could be, lose out to other coins or other networks. There's just so much that can happen. It's such a volatile market. And while it is growing and there are great gains to be had, it's very risky, period. I don't think there's anyone that can doubt that or dispute that. But it's a great opportunity as well. So I want to be in it. I just don't want to be in it huge. So anyway, this is just to give you guys an idea how what my ideal investment strategies are, or allocations. Food for thought. And if you like this kind of video, I can always go deeper into any of these. But really, I'll specialize on this channel in trading. Thank you for watching.